Hello everyone. In this installment, we are going to create a standard reporting for Vane & Sons leather jackets. We had this as a suggestion, as a design, but it turns out that Power BI does not exactly lend itself to this exact form and structure of reporting, this kind of table form. So if we wanted to have this, we would have to use Excel as a front end. That would be a very good solution. It probably could be done in Power BI, but it would take a lot of acrobatics with formatting and measures. So we will create a standard reporting in Power BI that conveys the same information, only in a different shape. The next problem we run into is to calculate a margin that makes sense, because the production costs are based on jackets made per month. And as you see, the number of jackets made during the same year from month to month is fairly consistent. It's pretty much the same number every month. While when you look at the numbers of jackets sold, they vary a great deal from month to month. So we would be comparing very strongly fluctuating revenue with pretty consistent production cost. That doesn't make sense. It is not considered how many jackets go into the warehouse and how many of them come out every month for sale. So I solved this problem with a trick. First, I created a product year month column in both the sales table and the direct cost table. First, format the date into year month, and then combine that with the product ID. In the production costs table, this number will be unique, and so we will have a one-to-many relationship to the sales table, because in the sales table this will occur a lot more times, so they will not be unique. Some values will repeat, and it appeared to be the best way to use the lookup value function to get the COGS, the costs of goods sold for each jacket out of the production costs table into the sales table. Then multiply it with the number contained in the invoice position, so I get the COGS per position, which then leads me to calculate the margin per position. To show you the difference, depose the values of sum of direct costs and sum of costs of goods sold per position. You see in January, the sum of direct costs is pretty high. It's so much higher than the revenue. It's like almost 5 times the revenue. In February, the sum of direct costs is very close to the revenue. In March, again, sum of direct costs is much higher. Then let's see, there was one big difference in that year. Yeah, you see, in June, the revenue is pretty high and the sum of direct costs doesn't fit, while when you look at the costs of goods sold per position, that makes more sense in the mathematical relation. When I have a project that requires more than, say, 7 different measures, I like to put the measures in a separate table to have a bit more oversight and structure here. So I have created for example, the revenue delta measure, which just is the difference between the revenue and the planned revenue, and the same in percent. That gives me the planned revenue in percent, which is of course formatted as a percentage. Have direct costs delta, again calculating the difference and then giving me the difference as a percentage, and then putting it all together in a table. And so far, this table looks quite devastating to me. Nobody can read this. So either I'm going to end up putting each category in a separate table, let's say revenue, with the deviations in one table, then direct costs in one table, and the margin in one table. I might end up using a completely different structure, completely different format. Yeah, we'll see. Right now, this is not great at all. The thing is, in the planning, we have no seasonality, and we accepted that in the beginning. Also, we do not have the granularity that we can break down the plan onto each product. Therefore, we will always have deviations going up and down very strongly. Like in January 2009, yeah, we have a deviation of minus 88.6%. In February, it's only minus about 40%. In March, again, almost 69%. In April, about 60%. May, it's about 96%. And in June, we are 73% above when it comes to the revenue, because we have no seasonality in the planning. So it's going to jump up and down from month to month. When we look at the values for the whole year, here we're not too far away. We have exceeded the planned revenue. For 2010, the whole year is also not too far away. We're a little bit above it. 2011, that's a bit further away. 2012, we're pretty close. But then again, when in 2012 we look at each month, yeah, it goes up and down and up and down. It varies a great deal. So that will be, well, look at this deviation. So this will be a lesson for the next plan, to make the plan with more seasonality. Although I have checked out the seasonality, and there also is no predictable seasonality in the whole thing. But yeah, at least one could plan on single product level. Then we could also adapt the COGS to the actual amounts of jackets sold, because this was planned on jackets sold, but with no fluctuation. So we did not expect such fluctuation in the sales. Show that there is no predictable seasonality in these sales. I've put a revenue chart with the date in the x-axis, and we can see now in 2009, in December, we have the highest revenue by far. 2010, suddenly it's March and what is that, June? 2011, it's March and October. 2012, it's, what is that, May and September. 2013, it's March and May. 2014, highest is November, second highest is, that's probably April, I guess. Yeah, so there is no predictable seasonality. It's quite erratic. Therefore, planning on seasonality will be quite difficult. All right, structured the thing a little bit. So for just for the 1 month reporting, this is actually designed to be a 1 month reporting, and we will later create year-to-date reporting as well. But for that, this is pretty much it, because we do not have any information about overhead. Maybe we will be given that information, but right now we don't have it. And when we look at every respective year, we see the deviations are not in some years not that great. So the lady in accounting was developing a pretty good feel for the business over the years. That's not bad. Some quite small deviations. So she made good estimates Well, here not so much. 2020, we all know what happened in 2020. In 21, they were a little too optimistic, and 22 also. Yeah, but this is a good start. This is not looking great by any means, but for the basic structure, this is a good start. Now, this is the closest I got to the structure of the suggested report design using Power BI, which shows again that Power BI does not exactly lend itself to great tables that give a great overview. I wrote about 35 measures for the whole thing, and if I have, say, above a dozen measures, I put them in a separate table and try to sort them by names that make sense. But you can see, I mean, this, yeah, it has the accurate numbers, but what does it really tell you? I mean, you can hardly see anything. And Power BI is famous for its visuals. And this is, yeah, it is sort of informative if you look at it closely, but it's by no means a great result. Now that you have something that doesn't really do the job, you try to design something that does do the job. So I ventured into different variations to suggest to management. So one was this, to have these small visuals, but I wasn't really satisfied with that, so I abandoned that. I didn't even finish it. And then, yeah, I tried this with more space, so the columns would have enough space to actually show the differences between the columns. And then I finally settled for this as a first step. This gives you a clear picture of the strong fluctuation of revenue from month to month. And this year, here you can select the year. In 2016, January and February were pretty close to plan, but then it starts deviating quite a bit, mostly in November and also in December. In 2015, January and February are further from the plan, and September shows the biggest deviation. 2011, you have the biggest deviation in March. Then I thought about where do I put the deltas, the differences between plan and is, both in absolute numbers and in percentage. I thought about putting multi-row cards, but then the graphs wouldn't have enough space. So I put it into the tooltips. 338% deviation from plan. So yeah, that's over, it's more than 3 times the plan. And in this case, you're about 32% under plan. And then the COGS and the margins show similar relations between plan and is because they correlate pretty much. You only have 6 products which are similar in COGS, in costs of goods sold. So that is to be expected. On this page, we have a comparison to last year. And you see, I've chosen to obviously show the whole year because the variations in revenue are so big that just reporting 1 month wouldn't make sense to me in that context. And there is the occasional month where no invoices went out, like here in December 2012. There's no is numbers because no invoices went out. So when you look in 2013, again, the previous year column is empty. Then I have year to date comparison to plan. So you can see that the deviations from plan become smaller and smaller towards December because the plan has been pretty good for the whole year. Just the seasonality was not planned. And actually we do not have a real seasonality. We just have immense fluctuation when it comes to the revenue. So when the customers decide to order varies a lot from year to year. So you see towards the end, is and plan are pretty close in many years. In 2020, not so much, because in 2020 a lot of things plummeted. And then 2021, one was a little less optimistic, but still too optimistic. And in 2022, we're pretty close again. Here we have comparison to last year, year to date. One might argue whether this makes sense, but you can see that 2020 has plummeted quite a bit compared to 2019. And then in 21, still not great, but yeah, some variation. I thought one good angle to explain to management why there is such deviation between plan and is, and also from year to year, is to show the fluctuation in amounts sold. So the planned amount for each month is the same for the whole year, because we did not consider any fluctuation. And you can see you cannot foresee the fluctuation anywhere. There's no real seasonality here. It's not like sales explode in December every year. It's different every year. And the differences in amounts sold, of course, get us very different revenues. So this would be a good way to explain to management. You can see in the plan, the amount every month is the same, because we just divided by 12 the planned amount, and there's no fluctuation. So the question is, yeah, on the one hand, it doesn't really make sense. On the other hand, how would you foresee that? Maybe somebody who really knows the market and really knows the customers might be able to foresee, but we have no real patterns that we could incorporate into the plan. Then I thought of yet another angle. We do not have the granularity of planning per product yet. So I thought maybe the COGS per product are similar to one another. Like Bikerdude L might be similar in production cost to Rebel Cause L and Rebel Cause M. And in fact they are. They are so similar that one might wonder whether they were accurately recorded. So in the first year, they could not, the company could not use rebates for buying in bulk. So everything was a bit more expensive. In 2010, they could buy more in bulk, get more rebates, probably get some cash discounts because they could pay more quickly. Liquidity was good. Then it stays pretty much the same for a few years, just goes up a little bit. And in 2020, of course, they go up quite a bit. In 2021 again. In 2022, maybe they found different sources to buy from. But I thought maybe one could use an average of the COGS to show the COGS, the direct costs, the costs of goods sold, which is the direct cost, the production cost. Maybe they are similar enough to compare the planned development of COGS to the is development of COGS, although in the plan we do not have it product per product. But in this case, they are similar enough to tell a little bit of a story. So that's what I did. I put the actual production costs for each product in average over all 6 products in this bar chart together with the planned production costs. And we can see in the first year the actual production costs were a little higher than planned. Were they ever lower than planned? No. But in this year the difference is pretty high. It is the highest in 2020 because probably nobody saw the jump up in prices. And I thought about putting data labels on the bars, but they would be very small. So instead I put a table next to the bar chart. What might be a good next step, because you cannot foresee the fluctuation obviously in this company when it comes to sales. It just varies so much from month to month that you would define a planned production cost per product in the granularity of each product, and then multiply that with the actual amount sold and hold that against the actual COGS for the amount sold. That might be a good next step. In any case, have fun, Godspeed, see you next time.